This is every property investor's worst nightmare, and there are two sides to it. On one side, imagine you buy a property today only for it to be worth less tomorrow because the markets drop. On the other side though, just as bad, you wait too long, property prices rise, and now you're left paying more than you really should have. And today, thanks to the current rental crisis, a lot of investors are finding themselves caught between this rock and a hard place. They don't know, should they buy now or should they wait? They're not sure what their next step is, and their concerns are valid. Look, I've been investing in property now for over 23 years, and I have seen how quickly things can go wrong if you get this decision wrong. That's why in today's episode, I'll break down what's really going on with the rental crisis and what you need to know before you make your next property investing decision. First of all, we need to understand what's really driving this crisis, because when most people hear the words crisis associated with anything to do with the property market, they assume the property market is going to crash, prices are going to fall, maybe landlords or owner-occupiers are going to sell their properties. But that's actually not the case. This rental crisis is because we don't have enough properties available in Australia for the number of people who want to rent. Yes, not only do we have a crisis where we don't have enough properties for people to buy, we also have this situation where we don't have enough properties available for people to rent. So where demand is higher than supply, it drives prices higher, both in this case from a rental perspective, but also in terms of actual property prices. But if you're confused about what this rental crisis might actually mean for the property market, I don't blame you, because the mainstream media, they're not actually making it any easier when they put out confusing headlines like this. Rental vacancy rates rise to 1.3% as market loosens in key cities. Advertised rents begin easing. Australia's national residential rental vacancy rate rose to 1.3% in April, according to new data from SQM Research, indicating early signs of a softening rental market. The figures mark an increase from 1.1% in March 2025 and April 2024, reflecting greater availability across major capital cities. Melbourne recorded the sharpest increase in vacancy rate, hitting 1.8%, up from 1.1% a year earlier. Sydney followed closely with a 1.5% vacancy rate, up from 1.2%. But then if we look at Brisbane's vacancy rate edged up to 1%, with a slight year-on-year decline in total vacancies, suggesting ongoing market tightness. Perth and Adelaide recorded low vacancy rates of 0.7% and 0.8% respectively, though both cities saw increased rental availability. Now, there's two important pieces of information that are missing from articles like this. First of all, what exactly is a low vacancy rate? Many people think it's zero. That's actually not the case. When we look at an area, we want to see a vacancy rate of 3% or lower. Why 3%? Because a 3% vacancy rate normally indicates there's roughly similar number of properties available for rent as there are similar number of people looking for places to rent. So there's an equal match. Whenever we see areas with vacancy rate under 3%, and especially what I like to look at, areas with vacancy rates under 2.5%, that indicates that these are areas where there are more people looking for places to rent than there are actual properties available for rent. And like you saw in this article, regardless of the fact that vacancy rates might have increased, every area still has a vacancy rate of under 2.5%, most of them under 2%. So we still have a rental crisis in that we don't have enough properties available for the number of people who want to rent them, and that's driving rents higher. But here's a second piece of information that's missing from articles like this. Rental vacancy changes on a suburb by suburb basis. So in Melbourne, yes, the overall vacancy rate might have risen, or even though it's still low, but the overall rise is being driven by certain suburbs where too many investors have gone and bought so-called investor hotspots, and that's driven the vacancy rate up. There are certain suburbs in Melbourne where the vacancy rate now is above 4%, which is actually too high. It means then that tenants have more choice in terms of where they want to live, and rents are actually dropping. So you need to do this due diligence on a suburb by suburb perspective. But overall, on a nationwide basis, it's very clear we don't have enough rental supply for the amount of rental demand, not enough properties to rent for the number of people who want them. And what happens whenever we have a situation where there's not enough supply for the number of people who want something, whether it's bananas, houses, Taylor Swift tickets, whatever the case is, whenever we have a situation where more people want something and there's not enough of that thing or those things to go around, prices rise. That's why we are seeing rents continue to rise in multiple areas around the country. That article that I referred to earlier on goes on to actually say that, sure, vacancy rates may have risen slightly month to month, but that's very seasonal. That's often what happens in winter. It's cold, I guess. People don't want to move house unless they actually have to. And this rental crisis, it's not temporary. The latest data shows it could be around for at least another 15 years. Personally, I think it's going to take even longer than that to fix, because we have a growing population and yet our construction levels are falling. So we're not building properties fast enough, no matter what the government might tell you. So that means that rents are likely to keep rising in multiple locations around the country for another 15 years or longer. And that's also going to force property prices higher as well. So don't be put off by these articles talking about vacancy rates rising. Do your due diligence, but do it on a suburb by suburb perspective. Because if you don't, you can get this wrong and end up paying more than you really needed to. A client of ours recently admitted that they came across our content about 6 to 8 months before they actually enlisted our help. And he actually went on to say that when he first saw our videos, he thought that we were horribly wrong. He said that because there was a rental crisis, rents were rising, people were struggling to afford their rents, property prices are becoming less and less affordable for many people. He thought that therefore prices had to fall. And here I was saying that at the time he came across our content that prices were likely to rise. So he admitted he actually kept watching my content for comedic value. He was waiting to be able to laugh, waiting to be able to see that I was totally wrong and what he thought was correct. But what happened? Every month, prices kept rising, especially in some of the areas that suited his particular budget. And he started to realize that the way we look at data was very different to perhaps what he was seeing in the mainstream media, very different to what his friends and family were saying. And by listening to them, he was actually missing out. It still took him 6 or 8 months to verify that our analysis of the data was correct. He then enlisted our help and has done very well. But if you're someone who does not want to make the mistake of sitting on the sidelines and waiting and then seeing prices rise and looking back with regret, I put together a free checklist that you can download by clicking the link in the description below. This checklist goes through some of the biggest mistakes property investors make, how to avoid them, and how to ensure you maximize the upside from your next investment property. So make sure you click that link and get that checklist. But I guess the ultimate question for you is then, should you buy a property now or should you wait? The answer is probably one you're not going to really like. The answer is it depends, not just on your own personal circumstances, but also on the markets that you're targeting, because not every market is going to rise around Australia. So if you're looking to buy an investment property, make sure you target areas where there's greater demand from owner-occupiers than the supply of available properties. Now, you might be wondering, hold on, Nero, I'm an investor. Why am I worrying about demand from owner-occupiers? 2 reasons. Number 1, capital growth comes from areas where demand is higher from owner-occupiers, people who want to buy property to live in an area, than the amount of supply. So as an investor, that's what you want. But then what about rental demand? Yes, that's what you also want to check. However, here's what happens when you buy in an area where there are more owner-occupiers buying than the supply of available properties. The number of properties to rent reduces as well. So therefore, tenants have fewer and fewer properties to rent, okay? Let me give you an example just to illustrate this. Let's say you're buying in an area where there used to be, say, 10 properties available for rent, and there were on average 10 potential tenants looking for a place to rent. A balanced market, not a problem. But then over time, we've seen people moving into that area, and they're mainly owner-occupiers. They're buying up those properties that used to be available to rent. When the investor then puts it on the market, owner-occupiers are grabbing those properties. Now, let's say there are 7 of them. So 7 owner-occupiers buy those properties. That means that where there used to be 10 properties available to rent, there are now only 3. And yet you've still got 10 tenants who used to have their choice of 10 tenants, 10 properties. Now you've got 10 tenants. What does that mean? It means then that you're going to have a greater confidence if you're buying in this market that your property will get rented out quickly because there are fewer properties to rent than potential tenants looking, and rents are likely to rise. And so by buying in areas where there is stronger demand from owner-occupiers and available supply, you get the best of both worlds. You get the capital growth that you're after, and you're more than likely going to get the rental growth as well, which will improve your cash flow over time, will improve your borrowing capacity over time, and will help you then get one property that leads to another property over time and help you build that property portfolio that you're after to help you achieve your financial goals. So now you know how to position yourself in this current rental crisis. But that's just the first step. If you're serious about building wealth through property, you need to know how to make your properties profitable enough so that you can replace your income. And if that's of interest, watch this next video where I walk you through my 10 steps to make $10,000 a month through property.